I'm Jesse Bobrowski, and the highest and best use for our business is closing deals within 24 hours and lending to real estate investors with as little as $20,000 down.
Thanks for tuning into the Highest and Best Use Real Estate Podcast, the show where we talk about techniques to optimize your land, structure, skill sets, and time, as well as the highest and best use principles to make your business more profitable, productive, and efficient. I'm your host, Ryan Carr, reminding you that good deals are found, great deals are created. And today we have Jesse Bobrowski on the show from Calvert Home Mortgages. Super excited for this episode. Jesse, thank you so much for being here.
Thanks for having me, Ryan, and thanks to all your listeners for joining us.
Say a few points about you, because your story is pretty cool. You're a VP with Calvert Home Mortgage, and you're the lead of the underwriting department, which I think is really interesting. I want to get into that today. You're a registered appraiser, and you also have plans to grow Calvert to $1 billion fund. This is impressive. I'm gonna close the show with the $1 billion fund because that sounds fun. But man, $1 billion, that's big.
Yeah, it's big. It's ambitious, though it's definitely achievable. The work that we're doing, supporting real estate investors in Canada, in the markets we're in, definitely is achievable.
This is great, man. I'm excited. Tell everybody a little bit about yourself.
Yeah, I'm a partner and vice president of business development with Calvert Home Mortgage. A bit about myself: I am the father of two great kids. My boy Ari is 6, my daughter Mila is 4. One amazing wife, Anar, and
just one wife.
Just one, yeah, just one. Educated in, actually, I'm from Ontario. Have an honors Bachelor of Commerce, educated in marketing and finance. Moved out to Calgary 16 years ago to pursue my dream of trading stocks. 6 months into doing that, I realized that it wasn't for me, and I met an amazing husband and wife who did their own private lending pool, predominantly syndicated. Worked for them for 8 years. And fast forward 8 years, I joined Calvert Home Mortgage 7 years ago, and have been with them ever since. We have grown our fund since then from a $45 million fund to what today is a $330 million fund. And a lot of that growth is through supporting Canadian borrowers who are looking for short-term mortgage solutions. And the bulk of that short-term mortgage solution that we're doing are helping real estate investors who flip or burr properties. Right now, we're focused on Alberta and Ontario, larger markets above 100,000 people. And we believe that there is a lot more we can do to support these clients. We know that in Canada, we have a major shortage as it relates to single-family houses. People want to live in larger urban centers. And what these flippers are doing and burr clients are doing is basically they're creating housing stock out of what currently doesn't exist. They're finding underused houses that the market doesn't want, refitting them for what the market's looking for, whether leaving it as a single family house, maybe converting into higher density or building something new altogether. So we know that they're providing a vital solution to our housing market, and we think that there is a lot of demand and a big future for that.
That's super cool. As far as how you got tagged up with Calvert, I mean, tell us a little bit about that story. That's 7 or 8 years back?
Yeah, 7. I guess it would be 7.5 years ago. So when I joined the private or the alternative mortgage industry 15 years ago, in Alberta, there was very little regulation as it relates to our investors. So as it relates to how we interact with rules, processes, and procedure, reporting for the investor side. In 2010, that all changed. The Canadian Securities Commission designated mortgages as a security. So during that time, we went through a big regulatory change. And in order to properly go through a big regulatory change, you need to involve a lot of experts, lawyers, accountants, regulatory consultants, and these costs are large and this learning is large. So what we did as an industry in Alberta is we got together and we formed the Private Mortgage Lenders Association. And I represented my firm at that time, which was called Cedar Peaks Mortgage. And Calvert was represented by both Dean and Dale Keller, who are my now partners. So I got to get to know them and learn from them and work with each other 12 years ago. And through that process, I gained a lot of respect for them as business owners and for their business. And then when the time came for me to leave the position I was in, it was a natural fit. And we got to talking about what their future looked like and what my future looked like. And it seemed that we shared a lot in common. And through that, I made the decision to join Calvert Home Mortgage 7.5 years ago.
Isn't it interesting how a regulatory change it cycles up your world, it cycles up the world's economic environment, and then boom, you meet new people and opens doors, a completely new path.
Yeah, it was really interesting. And even like my mindset at the time, being young and relatively naive, was that, we don't need red tape. Why are we regulating this? Although looking back, we absolutely needed some red tape for the investors' protection, also for how we were reporting, how we organized our business. It really provided a boost to those who embraced that regulatory change and saw the need for it. So there was some consolidation in the market through that, but I think it was for the better. It was for the betterment of our shareholders as well as our borrowers. The alternative / private mortgage industry is a lot more formalized today than it was, and it's continuing to progress and evolve, which is a good thing for the two key parties, which are shareholders and borrowers.
For sure. Two things that I picked up on that you had mentioned there. One is red tape, and two is the question of being an EMD. Are you guys an EMD? Does that apply here?
Yeah, absolutely. So
what does that mean for the listeners?
That was one of the big changes, is that in order to raise capital, we had to do it through a licensed party. And what we do here at Calvert is we are our own EMD. So we've built an EMD. We've built policies, procedures around that. And so we are licensed. Our primary regulator is the Alberta Securities Commission, who we report to. But then in any province in which we raise capital, so for Calvert, it's BC, Alberta, Saskatchewan, and Ontario right now. We have to abide by their regulatory regime. We have to report the capital that we've earned. And it's basically, the onus is on us to know our client, know who we're raising the capital from, understand their sophistication as an investor or lack thereof, understand what their net worth is, understand what their risk tolerance is, and equally as important, for us to understand our product and properly report that to the prospective investor. So audited financials, quarterly reporting on some key KPIs, something we were doing prior to the regulatory change, but not everybody was. So we have an entity within our business that is called an exempt market dealer. We have placed restrictions on our specific business where we only raise money from accredited investors. We don't have the other option would be to build an offering memorandum and raise money from the broader market. But we've seen, based off of our product and the investors we want to serve, it makes sense for us to be working with accredited investors. So that would, the basic thresholds for that are either having $1 million net financial assets or earning above $200,000. The vast majority of our shareholders qualify through investable assets.
Right.
We've even how we've evolved our investor pool has changed, where as we scale, we see the value in building lasting relationships with larger pools of capital that can grow with us, that understands our business, that is doing a lot of due diligence and rigor around our business. The way that I look at it is, the better you understand our business and risk, the better we are to be issuer and investor.
Yeah, well, let's talk about risk. So, and I love how this conversation is just naturally evolving. It's like you have a set of questions that you want to talk, and then like awesome stuff comes up. So we're going to talk about risk. You've obviously heard what's going on across Canada right now in terms of people going upside down, bankrupt, over leveraged, things like that. I mean, being an EMD, having so much regulatory oversight, and obviously being experienced in the business, what are you seeing in the market right now with the way that this is unfolding, and how does Calvert try to alleviate that as a follow up to that question?
So, okay, so kind of two parts. So, what are we seeing in the current market?
Well, in
And
terms
what are
of
we doing to alleviate?
yeah. So, what are you seeing in the current market right now in terms of obviously there's a lot of people going bankrupt. There's with the
Yep.
market changing. There's a lot of people who were either over leveraged or got into investments where they weren't vetted correctly, and people are losing their money on the lending side. What are you seeing right now with what's happening to this?
Yeah, there's a lot to unpack there, Ryan.
Yeah.
So let's start with what we're seeing. So, Calvert and myself have essentially built our business and careers uh, of lending in Alberta. And that's good and bad. The really good thing is that Alberta goes through really big cycles of appreciation and depreciation. And the cycles of depreciation from a risk perspective are awesome because you get to learn what works, what doesn't, and build models around protecting your downside risk. So, something we try to do really well is be experts in managing risk. Going to Ontario was a big eye opener for us. The psychology there was a lot different than Alberta's, where people didn't understand the downside risk as well as we acutely did because of we usually it's about a 6-year up and down cycle. So experienced investors in Alberta will always understand that the market moves both up and down.
It's funny how your market's so different than Ontario. Ontario is just it's been straight vertical for 20 years, and then you guys kind of cycle with oil.
Exactly. Whereas in Ontario, like you said, it's been really great for 20 years.
Yeah.
And that builds some psychological models where you believe that the market only goes up. And the dangerous thing about that is that people begin to speculate. People really stretch themselves, right? Like have all your capital outlaid in multiple projects and continue to invest your profit, not taking anything off the table, not considering what happens when and if. It's a matter of when the market turns.
Sure. Warren Buffett, I mean, when the tide goes out, you see who's swimming naked, right? That's what it is.
Yeah. So we're seeing a lot of that come to roost now in Ontario where people were extended and when the market turns on them and there may not be profit in some files, they're going to lose. And we're seeing that now. So, where we're seeing some of our borrowers go into projects where they're now taking a bit of a haircut on it. And the problem, or that's natural. So unfortunately, for the last 3 years where they've been hitting triples and home runs, which is not normal for our clients. Usually we're used to our clients hitting doubles and singles and doubles, making between 30 and 60 grand per project. In Ontario, people were making 100 to $250,000 a project.
On a flip, for example.
On a flip.
Yeah.
And continuing to roll that profit into the next flip. So right now you have some clients that have 10 on the go, all their money out, and they've seen the market turn 20+% in the last 7 months. And they're going to lose. And unfortunately, the people that were fully exposed are going to lose it all. They don't have the ability to make payments. They don't have those reserves. They haven't diversified strategies. They haven't diversified geographical locations. They've just continued to double down on what they thought was the best bet. So we're seeing that a lot now in Ontario. Alberta, on the other hand, where half of our book is, the market hasn't turned to the extent. Maybe it's down 5% from peak in March, but very manageable. Like our flippers and Burr clients can easily absorb that. What they can absorb is where they buy at peak and the market turns on them 20%. that usually results in a loss. So through the losses that we're seeing our investors take on in Ontario, we're also seeing, in the same vein, a lot of lenders, a lot of alternative lenders who have been in the space 20 less years, who have built their risk models around the market going up and lending high loan to value firsts and seconds, and the market not being able to mask some of that underwriting, right? Like you can do high loan to value first and second alternative mortgages and pat yourself on the back and be a genius when the market's increasing 5-10% compounded year after year. Where the issues come is when it doesn't do that, and it doesn't correct itself in a quick matter of time, which in all likelihood, that's not what the market's going to do in the next, call it 18 months, right? At some point, I think in the next year, the market will stabilize. So we'll find the floor. And I don't think we're very off of finding the floor, but even when we find the floor, we're still going to be in a relatively high interest rate environment. The affordability concerns, especially in Ontario, are still going to be there. So I don't predict the market balancing and then increasing at a very high pace. So the people that are losing today, there's no market fix for it per se.
Right.
We're just going to have to learn our lessons, suffer those losses, and hopefully learn and build better for the next go round. But certainly we're seeing a lot of in Ontario where, by the way, mortgages are not as regulated as in Alberta.
Really? I didn't know that.
Yeah, you have mortgage brokers placing loans on behalf of clients. You have mortgage brokers building syndicated portfolios. Again, not understanding mortgages as an investment, not having the regulatory hurdles. And
okay, so let's talk about that for a sec, because that's actually really interesting. I want to talk about the underwriting process, but this is really cool. So when you compare Alberta to Ontario in a lending environment, what would the main differences be? If you had to say like the top three in terms of regulation, what would the main differences be between each?
The main differences are that mortgage brokers in Alberta are very strictly regulated on how they can broker private capital into deals. Whereas in Ontario, they don't have as strict of regulations. And a lot of mortgage brokers have built businesses placing other people's loans in mortgages. That's worrisome because there's a big conflict of interest there.
Well, you're getting paid to place money where you don't necessarily have skin in the game. Is that the issue?
Yes. And also even how they report to their investors, how they look at risk. They don't have to go through that rigor that if you're a regulated entity, you would have to go through. So they're going out and raising money from mom and pop investors. Like for instance, we again, earlier we talked about the level of sophistication our clients have. Even with that level of sophistication, we try not to allow any one investor to have more than 10% of their portfolio with us. Where for instance, right now, like I'm looking at a file that we're tied on, and I'm moving through a power of sale on.
Yep.
And we may break even, we may lose 10, 20 grand. And there's a second mortgage behind me of $150,000. And
they're toast. You might be okay, but they're toast.
They're toast. And that's an individual.
Yeah.
And I reach out to that individual and their lawyer and start asking questions about their net worth, and they're like, this is half of their net worth in one file that they're losing all their money. Like,
tough, yeah.
Those things shouldn't happen. There should be regulations around that. And I know, some people may say, let the free market do what it does, but in talking to that individual, they aren't sophisticated enough to make that decision and understand the downside risk of having 50% of their money in a second behind an alternative lender.
So whose onus is that? Like who would be responsible for that? Would it be the person making the decision saying, yes, I want to take on a second for 100 and something thousand, not understanding the appraisal, the loan to value, all that? Or would you say the onus is on the broker for placing that? And I don't know what province this is in, but
I would say both.
Okay.
I would say both. Like the broker who's placing it. So for instance, when we're placing our money, we need to know our client, know our product.
Yeah.
Where the broker doesn't have that same requirement in Ontario. In Alberta, they do.
Gotcha.
So they're not considering what is your net worth, what is your risk appetite. They're saying you have $150, 150,000. I have a mortgage. Let's put you guys together, and I'm not saying that in this instance there was anything nefarious.
Yep.
They thought they were doing good business, but in retrospect, a lot of people are going to realize I shouldn't have done this business. This wasn't wise business.
What would the value of this house be? Open market right now?
This house, $600,000.
Okay. So presumably 12, 18 months ago, like we've fallen about 30% in Ontario, give or take. So that was probably $700,000 to $800,000 house.
Yeah. Call it 850 even. Call it 850.
Yep.
And at the time, they were at 85% loan to value.
Mm-hmm. Which is comfortable. That's pretty standard for a second. Assuming the market doesn't fall apart.
Yeah, although Ryan, if it's pretty standard in Ontario.
Right.
So if you go to Alberta where the market does move, usually I'll call it formal lenders.
Yep.
Alternatives included won't exceed 80.
Okay.
And very few go over 75.
Really?
Because in the event of what I like to say is in the event of a default, the lawyers are going to cost you $10,000 and the market's going to discount it by 5%.
Yeah. Okay. So let's talk power sale. So when you guys have a power sale situation, what is the process for that and how does this unfold?
So the process for power of sale is right away, we immediately look at what is the value today. Okay. So part of what Calvert does to manage risk really well is we have our own internal appraisers. So we don't use third-party appraisals. We do all of that work in-house. And the benefit to that is we can provide a really great service to our clients by valuing the property at no cost in a very time-efficient manner. The value for us is we're experts at appraising properties. Yeah. And through that, we have really good market intelligence. So the first thing we'll do is we'll value the property as is, where is in today's market. And then we'll do some analysis on, we'll discount it by 5% because that's what the market will do on a for sale. We'll engage our lawyer. We'll build in a $10,000 fee for that. And we'll back out all our costs and say, here's where we're going to end up. And in most instances, because of the lending we do, we're going to have a lot of room to work on that. We'll then engage a realtor to list the house. Mm-hmm. We'll make sure that we have a realtor that is well suited to be listing the house. So for instance, some of the files we have are partially finished flips, and we'll make sure that they have a network of investors. We'll make sure they know the power of sale process, that they are the right people to guide the market through this sale.
Yep.
And then after our waiting period, which is basically we have to give the borrower a 10-day notice plus a 35-day, I'll call it waiting period. Then we get to list the property and let the market do what it does. That's typically what happens in Ontario.
Okay.
In Alberta, it's a lot.
The borrower could come back and say, "Hey, I've got the money," right, and kill the power sale.
Yeah, absolutely. Mm-hmm. Yeah, and that's what we always try to work with the borrower. Power of sale is worst case scenario. Typically, what we try to do is just coach the borrower on what is the situation, what are your possible outcomes, and what is the best possible outcome for you. Because typically, the best possible outcome for them is the best possible outcome for us, where they exit the property, get as much money back into their jeans as possible, and pay us out.
So in terms of cost and expense as a lender, you'd mentioned $5,000 to $10,000 for lawyers. What does that include? Like a judgment, a hearing? What does that mean?
In Ontario with power of sale, it's typically just working through the paperwork. Mm-hmm. Very infrequently do we have to work with the judge, unless the borrower files I'll call it a statement of defense, for lack of a better term, and argues our power of sale. Mm-hmm. Then the process becomes a lot more involved and a lot more costly. But typically, the $10,000 is a buffer to deal with any back and forth we may have with the borrower. Sometimes there's a bankruptcy trustee involved, so it's typically less than $10,000. Like I've seen on average $4,000.
Wow, it's interesting because I've heard upwards of $40,000 to go power of sale, but what you're saying is it's not actually that much money.
No, and keep in mind, I'm not an expert in Ontario. Luckily, I've only had a couple of power of sale. Really, the first power of sale files we've seen in 2.5 years have just started bubbling up over this last quarter. So I'm not versed in it, but I haven't seen legal bills of that nature.
Okay. So on the underwriting process then, how do you guys vet a borrower?
So what we do, particularly when we work with, and I'll only talk about working with real estate investors because that is 75% of our business.
Yeah.
So what we do is first we look at what and where the property is. Is it something we want to lend on? We like nice, easy, homogeneous properties in large urban centers. The more unique the property, the harder it is to value. The less buyers there are, the more risk. So we take a look at the property. We take a look at the budget. We take a look at the individual credit, their ability to afford the credit, what their history has been. Are they versed in trades? What work are they doing versus what work are they hiring out? So we take a holistic view of the individual and the project. And we value the property after repaired. We back out all costs. We look to see what the real profit is for the borrower. If there's real profit for the borrower, i.e. they're not buying a job, like for instance, if you're buying a $600,000 house, putting $50,000 into it and might make $20,000, that's a little too thin for us.
Sure.
On that property, we'd want to see at least $40K. And if that's a yes, then we're going to support that project.
And there's $40K, that's like net, realtor fees, legals, everything done.
Realtor fees, legals, land transfer tax,
all that.
Utilities. We look into every line item and want to see them making net, or else we're out.
Do you do that with a formula, or do you do that just like back of a napkin? How do you guys actually calculate that? Percentage?
We have a really cool flip analyzer. Basically, it's an Excel spreadsheet that we've built out. It has some automation tools in it, and we use that for our underwriting. We also share that with the market, so everybody has their hands on it. We're actually right now looking at building it into app and web-based form to make it easier, a little bit more interactive, providing some more feedback. Like we could provide, for instance, property tax values around the neighborhood, recent sales. All that can be automated just to help our borrowers do their due diligence.
Sure.
But we have a tool that does that, Ryan. Yeah. And if they're capable of doing the project, if we trust them with our money, credit, if they have the capital to execute and the project is going to be viable, then we support them.
I love it. That's it. Yeah. Simple. So 75% of your business is investors. Being in the flipping space, how are you looking at the appraisal as appraised? Like let's say you're buying a smashed up property. The appraisal is not going to come in, but the after repair value might be fantastic. How do you guys differentiate between what it's worth now versus what it's worth when it's done?
We typically don't look at what we consider what it's worth now is the purchase price.
Okay.
The as is value really doesn't have a big bearing on our loan, because what we look at is how much are you investing and what's it going to be worth when it's done. And when there's profit built in, we know that the buyer's buying the right as is purchase price. As you and your listeners know who have flipped or bird properties, the hardest part of all this is finding the property. So when we run our analysis and there's margin, we know they're buying right. So we don't look at the as is value. We look at the after repaired value and support them based off of that.
How does that affect the book value of your loans?
The book value we're reporting at is the after repaired value. So right now, our total book loan to value is 59%. So every 59 mil we have out, we have $100 million of real estate assets backing us. The risk is if they don't execute, but historically that is very low. The only time we have clients not executing is when a major life event happens.
Right.
Something within the family, addiction, where they just lose focus of the property, because typically they have a lot of money sunk on the purchase, plus there's profit there, so they're intrinsically motivated to complete the renos and exit the property. That's where their revenue is. That's where their profit is. That's where, in a lot of instances, their livelihood is. So yes, there is risk that they don't complete, but over 40 years of doing this and literally lending out billions of dollars, that's one of our lowest risk components to the book.
Interesting. Have you ever actually had to go to another wholesaler and say, hey, this project is upside down, rather than going power of sale, could one of the wholesalers in your Ontario, Alberta, BC network, whatever, take over a property that's maybe a little bit defunct? That way it helps the borrower, it helps you guys as the lender, and it gives the opportunity to the next person. Because you guys are on like every wholesaler's buyer list as the champion of financing.
Yeah, and so when we talk about power of sale being our last option, that's the value we provide to borrowers is, hey, you have an issue. We don't need to go through power of sale. What do you think this property is worth today? Okay, yeah, we agree. Do you want us to market this throughout our network? And marketing it throughout our network, we'll be reaching out to our wholesalers. It'll also be reaching out to our clients, like our flippers, our borrowers directly, because usually they're going to be able to pay a little bit more than a wholesaler was because they don't need that margin.
Right.
So we'll use every means necessary to help our borrowers in those instances. And like you said, that there is perfect. We're creating a win for the borrower. We're creating a win to our network, and really helping out the situation.
So highest and best use of capital. What are some of the opportunities that are naturally generated by having a pool of 330 million? Like, you guys have your fingers all over it.
Yeah, so we're always looking for the best risk-adjusted lending opportunities. And what we start with is, okay, what do the banks not want, right? Like the banks are so massive and their cost of capital is so low that if they want something, we don't want to compete with them. Right. So with our market scan, it's clear that they don't want short-term lending. So we said, okay, let's build our strategy around short-term lending opportunities. Where do most of those exist with the lowest risk-adjusted return? And that's where we came across, okay, these real estate investors have a real distinct value proposition. It's a unique market space. It's something we want to serve. They're professional borrowers, and that's where we want to get. So that's where our highest and best currently is, but we're continuously scanning the market, looking at what our competitors are doing and figuring out where we should be supporting people that others aren't. Highest and best use of capital, though, also is, what does our capital structure look like? So sure. our $330 million today, $130 million that is bank debt. So we borrow it at prime plus 0.75 from the banks and lend it out on average at 10.17 and provide some real great value to our shareholders by doing that.
What's the spread there? What would the spread there be today? 10.17 minus prime plus whatever you said, quarter point.
Call it right now, on average, we're paying 6 for our bank debt.
Yep.
So that's a 4.17% spread.
So for every dollar you lend out, you make 4 cents.
Yeah. Great. For free without doing anything.
Yeah. How do you get a line of credit for 100 and something million? That's heavy.
It's heavy. It's a lot of work. It's a lot of work on reporting. It's a lot of work on data and intelligence to the banks.
Yeah.
It takes a really good history of lending, showing them that we know what we're doing. I love it as a shareholder because the banks are continuously challenging us on our book composition, on where our portfolio is, on our lending practices. So it's almost a check and balance for our shareholders that we know that there's these big FIs who have given us money and who are looking at how we manage risk.
Right.
So it's something we're very proud of, and it's something that it's a relationship that we anticipate to continue to grow as we grow our book. So the line of credit today is approved for $200 million. We're only using 130 of it. And the current facility will take us through for a while, but we know as we grow, we'll have to continue to work with our bankers and build that relationship to support us. So that's one thing we do for highest and best use of capital. Then the other, call it 200 mil, is high net worth individuals, family offices. We have a couple money managers who have invested their discretionary funds with us. Mm-hmm. Out of that, right now we have 30 million, give or take, sitting in a debenture product. So the debenture product, we're paying less than our equity. The goal is to pay less than our equity. The goal is ideally to pay less than bank. But in today's market, where GICs are, we have to pay a little bit more. So it's between 5 and 7% we're paying for that capital. And that is maximizing. We're always looking at our weighted average cost of capital and driving that down.
Can you explain what a debenture is?
Debenture. So the debenture is basically a guaranteed from our company shareholder loan. So the client gives us the capital. We pay a fixed rate for a fixed period of time. It's secured by our book of business. So if you wanted to look at risk of our whole $330 million, if something were to happen and we were to have to liquidate, the first to get paid would be the bank, the 130 from the bank.
Yep.
The second to get paid would be the 30 from the debenture. And then the rest, the other 170 to get paid, would be our preferred shareholders.
Gotcha.
Our preferred shareholders, we have an overall history of paying 13% over the 40 years we've been around. It's more relevant to look at what we've done the last 10 years, where we're 9.8% return on average. So the more efficient we are with our capital, the better return that we can give to our shareholders.
Very interesting. And does your pricing fluctuate based on, does your output pricing fluctuate based on where the bank is lending? Do your shareholders have an expectation of what they want to receive? Or when you guys are playing the spread, the cost of debt fluctuates, right? So how does that affect the borrower on the back end?
Yeah, it's a combination of many things. So what we like to educate our shareholders on is we're doing a great job. And again, we always look at what the lending environment is. But right now I'm saying, hey, if you are going to invest with us, we're doing a good job if we're returning between 8 and 10%.
Yep.
If it's below 8, we're doing a subpar job, and we'll educate you within our financials and our management discussion and analysis. If it's above 10, give me a pat on the back. I don't expect, but do not expect that. How we price to borrowers is dependent on, yes, what the Bank of Canada is charging, but more so what the competitive environment is, right? We can only charge so much, and we can only charge so little. So our goal is to be as fair as possible to our borrowers and provide them value within the money we're lending them. So yes, we've had to bring up rates. We've increased our rates essentially half of what the Bank of Canada has. So on average, 1.75 our rates have increased since this quantitative tightening. And looking forward to the next couple rounds of what we view is the market has baked in another 0.75% of increases. We think 0.25 in December and then 0.5 in January is what we're anticipating. We'll probably increase our pricing lockstep with the bank at that time, although that's not necessarily going to be the case. It's just we're building scenario analysis around what's happening. So long story short, it's very dynamic. There's a lot of inputs we consider, and we are always trying to do the best for the client and the shareholder, the borrower and shareholder when pricing.
Where do you think the biggest opportunity is for the borrowers coming up the next 12 to 24 months?
Borrowers coming up is find where the opportunities are. We have some of our sharpest borrowers getting back in. They're finding the deals. Your money's made by buying right.
Sure.
So for the last 24 months, our sharpest borrowers have been complaining that the buying opportunities aren't there. Seller psychology is too good. In order for them to buy, they have to speculate, which they don't want to do.
Yeah.
So now where seller psychology is changing, there are opportunities, and we think that there'll continue to be opportunities. We think our business will really increase when the market bottoms. Like right now, we have some of our sharpest borrowers borrowing, but when the market bottoms, we'll get more borrowers in. And you don't need an up market to be profitable at flipping or burring. You just need a market that's not decreasing at a high rate. And we're starting to see some of that peter off. Because if you're building in, let's say $40,000 on a $400,000 house, and the market goes down 5%, you're okay there, right? Your profits halved, but there's still money to be made and move on.
Yeah. You know what I like about the financial industry is that it can scale based on percentages. So many things, like it's hard to scale human capital, human labor, but the financial industry, like whether you're placing $1 in a second mortgage or 100,000, like the mechanism is still basically the same. So like when you guys are scaling to $1 billion fund, what does that look like?
What it looks like is definitely increasing our geographic location. So we entered Ontario. Right now, we're only Alberta and Ontario. We entered Ontario 2.5 years ago. This year, we'll lend out approximately as much money in Alberta as Ontario.
Right.
Pure population and household numbers tell us we should be 4x in Ontario. So this year we'll lend out 200 million in Alberta, 200 million in Ontario. Mm-hmm. When we fully have Ontario, when we have the market share we want in Ontario, we should be lending out around 800 mil a year in Ontario. Then we look at, okay, what is the next best place for us to lend? Where are the fundamentals great? Where are people moving to? Where is the economy stable? Where is a market where we already have really sharp participants participating? Mm-hmm. And our analysis tells us we're going to consider British Columbia. Yep. So we'll go there. And again, by number standpoint, we should be lending out about 20% more than we have in Alberta. So that would say we should be doing around 240 million in BC. And we think all of those combined, we'll be lending out 1.2 billion a year. And that will support $1 billion fund.
Wow. Think about how many flips and how many investors you could support with $1 billion. My gosh.
Yeah. Well, on average, right now, our loan is $420,000 per. So yeah, we're going to be able to support a lot of people to create a lot of great housing stock and provide a great livelihood for our borrowers, and also hopefully a great place for our shareholders to park and grow their capital.
Man, this has been amazing. Jesse, thank you so much for being on the show. Just like having the opportunity to sit down and effectively virtually break bread with you and have this meeting has been amazing. I can tell how much you really genuinely enjoy being with Calvert and lending cash and really understanding the fundamentals of the business. I think that's very cool, and you're very open and you're very gracious to share. So thank you again for being on the show today. Where can people find out more about you?
Yeah, so we have a really great website. Just Google Calvert Home Mortgage. The reason I say great, it's predominantly focused, it's all focused on our borrowers. So educating them, tips and tricks. I talked about our flip analyzer. It's there for you. We have case studies. We have economic updates, really building out resources to support our clients' business. So if you'd like that kind of stuff, Google us, go play on our website. There's tons of information. We also have a cool Instagram handle at Calvert Home Mortgage. Similar mindset where we're educating, we're providing updates, we're letting people know when we're on podcasts, when we're on webinars, when to expect white papers that we're producing. Those are the two best places to find us. On our website, you can see our phone number, our email addresses. I have an amazing team of underwriters who are probably more knowledgeable about serving borrowers than I am. So feel free to reach out to them for your borrowing needs. And if you're considering investing, myself, my partner, Dean Keller, and another colleague of mine, Garrett Labar, would be happy to talk to you about that.
Beautiful. Amazing. Any relation to Keller Williams, Dean Keller?
No relation. The last name is Koeller. So
it's the O. It's the O.
Yeah, Koeller. And their father, Dean and Dale's father, Everett, he founded us 40 some odd years ago. He's still the chairman of our board, and a really amazing guy, amazing family to work with. We're doing things the right way.
Beautiful. Awesome. Thank you again for being here.
Thanks for having me.
Thanks again for listening to the Highest and Best Use podcast. I'm your host, Ryan Carr, reminding you that good deals are found, great deals are created. Don't forget to sign up to the book at thehighestandbestuse.com. Like, share, follow, and subscribe, and we will see you on the next episode.